So we're waiting for the cue. 3, 2, 1, live.
Yep.
Does anybody have one of those app boards, like for a movie?
I think this is just being, yeah, really, streamed on YouTube. I assume Mary knows she's, there she goes.
All right, we are on.
Perfect.
Okay.
Well, it's August 26th at 3 p.m. and I'm going to call the Park Board Investment Committee meeting to order. And we have with us the entire committee, being myself, Jim Getz, chair of the committee, Park Board Commissioner, Kevin Flynn, Park Board Commissioner, John Nyer, a member of our committee, and Steve Pullman, a member of our committee, and Craig Sherman, a member of our committee, the CFO for the parks. So with that, our first agenda item today is a presentation by Fifth Third Bank relative to our investments with them. And Helen, I know you're on the line, so how about if I turn this over to you and let you do introductions and just take your presentation.
Absolutely. Thank you so much. This is Helen Webb from Fifth Third Bank, and today I'm here with Keith McFarland, the portfolio manager. We are going to present to you the performance report as of the last day of July of 2020 for the for several trusts that are held at Fifth Third Bank: the Meyer Trust for Cincinnati Parks, the Levy Clock, the Hauk for Fountain Square Trust, and the Sooty Acres Foundation. With that, I'm going to hand it over to Keith so we can dive right into economic update and the portfolio performance.
Okay, thanks, Helen. First, I will give an economic overview, a brief economic overview to talk about how that guides how we manage the portfolio. We got a new investment policy in October of 18, and by the end of 18, we had that fully implemented. So when you look at the returns, we will have benchmark returns for the longer periods. That benchmark hasn't been in place, but it just is there for more for reference. So we will look at the returns as we go through the portfolio, but first I'll give a market overview to talk a little bit about what has been going on in the market. Obviously, 2020 has been dominated, at least since mid-March, by COVID-19. We saw the market sell off significantly at the end of March. The other thing that happened, and I'll talk a little bit more about that when we get into the portfolio, is that credit markets seized up somewhat at the end of March and have gradually improved as we've moved over the last 4 or 5 months. We see the market to the point where the S&P 500 and other stock indexes, particularly domestically, are back near or above their record highs. In fact, as of yesterday, year to date, the NASDAQ, which is dominated somewhat by technology stocks, is up 28.66% year to date. And if you look over the 1 year period, it's up over 49%. And again, as many of us have had to change the way we work, many technology stocks have benefited by that change in environment, as schools have gone online and many of us who go to work now do so virtually. You look at the MSCI All Country World, which is a global, really looking at the investable world, is now up year to date 4.03% and 18.27%. So despite this global pandemic, equity markets in particular have recovered. So for example, if you look at second quarter GDP, which came in at a negative 32.9%, it was the largest quarterly contraction on record. But that drop was better than economists' projection of 34.7. And so the market seem to just shrug it off, much in the same way that unemployment for July came in at 10.2%, which was better than the consensus estimate of 10.6%. So despite millions and millions of people being out of work and a historically high unemployment rate, the market has looked at that positively. Now, part of that is one of the things that we have preached is the market is very much forward-looking. But when you look at those numbers, this is not something that's going to rebound in the next quarter, 2 quarters. This is a multi-year type recovery. So it remains to be seen what are the longer-term impacts on the market. The other thing that we have is an election year. And typically in election years, we have sideways markets. Typically what happens in an election, the market is not so concerned about who wins, but different things obviously benefit depending on which party is in power. Actually, markets tend to like divided government because that way you don't see big swings one way or the other. And so the market will show a little volatility until we know who wins, and then we'll perform basically on the fundamentals of the market. So with that, I'll get right into the portfolio, and I'll just add one other thing is since March, we saw interest rates essentially drop to zero. We had coming out of the financial crisis, we had interest rates drop to essentially zero before. We've seen interest rates recover over the last couple of years, and we're back to where we started. And again, as I said, credit markets somewhat seized up at the end of March and have begun to recover. But with our new investment policy, if we turn to page 3 of that report, just to review the asset allocation, and our target is 70% equities, 30% fixed income with that new policy. You see we're holding 3% cash, and we have held a little bit more cash over the last couple of months due to the volatility and to see more attractive levels to invest in fixed income. So if we go to page 4, we'll look page 4, 5, and 6, we'll look at the portfolio. And I'm going to focus on that first portfolio, the Carl and Helen Meyer Trust, and the other portfolios, with the exception of Levi Clock, which is a small portfolio, are all invested similarly. So when we talk about the portfolios, we'll be talking much about the same thing. You'll look at the fixed income column there, and you'll see DoubleLine and Dodge Cox, which are 2 high-quality intermediate gov credit type bond funds, which are both highly rated by Morningstar. And to talk a little bit about how those funds are managed, Dodge Cox more of a credit, with DoubleLine giving us exposures to asset and mortgage-backed securities. Both of those funds were impacted by the credit seize up in March. So when we look at the fixed income returns, we'll see how those returns year to date and what has happened over the last 3 months have varied. We see that that fixed income market has recovered. In the equity portfolio, you'll see it's a very much diversified portfolio. We use a lot of cheaper passive investments, and then you'll see the results of that when Helen goes over the fee report. Really in the large cap, which is the biggest part of the equity portfolio, you'll see the most significant investment is the iShares Core S&P 500. And again, particularly in large cap, active management has had difficult time outperforming passive. How we do gain some attribution, you'll see below the iShares. Core is the factor type investments where these are invested in specific styles, which are also passive, but we actively manage our allocation to each of those styles between minimum volatility, quality, value, momentum. And you'll see Harbor Capital is our active component, which is a growth fund, which has done very well over the last 3 or 4 years. We have reduced that allocation as we've seen that appreciation. The similar thing we do in small and mid, and we do have targets in the policy to small and mid and international. So a well-diversified portfolio using about 50% passive investments in the equity. So cheaply accessing the market and adding active management when we see where it can add value. So if we go to page 7, And again, this is where I will focus with the performance because it's going to be similar through all the portfolios. Different cash flows through some of the portfolios has a little bit different performance. So in some cases we've had higher cash at various times. But if we look at the performance, and I'm going to particularly focus on the short-term year-to-date performance, you'll see 0.9 versus 1.1 for the year-to-date. At the bottom, and that's the blue line, that's the overall performance for the portfolio, and we'll go at the top, and we'll look at the equity, the gray lines for fixed income, you see 5.3 or 6.1. And again, that's a function of the credit market suddenly seizing up at the end of March. But if you look for the 3-month and 1-month returns versus those indexes below, how 4.1 versus 2.1, 1.4 versus 0.8, how those fixed income markets have continued to recover. So that fixed income was just the market simply seized when we had that sudden sell-off. Equity, we have performed better than or in line with the market throughout the year, and you'll see particularly as you look at the longer-term performance versus the indexes, better performance in the indexes. So particularly if you go to the bottom, looking at the 3-year return, now this policy hasn't in place for that whole 3-year period, but you'll see gross of fees 7.8, net of fees 7.1 versus that index. And again, that performance has been somewhat affected by the fixed income, but performance that is in line and in some cases better than the benchmark. I'm going to jump ahead a few pages just so that we can highlight similar performance across all the portfolios. If you go to page 12 to look at the HALC portfolio, you'll see similar performance across the board. Again, all of these portfolios are managed in a similar fashion. The only difference might be the occasional cash flow. And if we go to page 17, the same thing for the Hawk Sooty Acres portfolio. And at the bottom, you'll see the last 3 months, 10% versus 9.9. And again, cash flow would be the only difference which would impact the performance, but they all have the same type of allocations to those portfolios. Now, the only other portfolio is a small portfolio of only 32,000, and it is not as diversified, which in some cases it is only invested in the S&P 500. And again, that portfolio, a little bit better performance on the short term because it is only large cap US. That's going to vary long term depending on what markets are doing better. So that portfolio only has a couple of different investments in it. So not as well diversified, but we're using the same asset allocation for that portfolio. So really that concludes the investment of the portfolio. I'll talk about what we have been doing during these volatile markets. And when you have what happened in March occur, there's no way it was what we call an investment, a black swan event. It was not something that we could have predicted. So the only thing you can do is maintain your discipline. So the one thing we did, and it was complicated somewhat by what happened in the fixed income markets, but is to rebalance. So we did add to equities when we sold off at the end of March, and we have rebalanced the portfolio several times over the last 4 or 5 months, more often than we traditionally would. We do tend to make incremental trades within categories pretty often, but rebalancing the entire portfolio is something we usually only do once a quarter at the most. However, over the last quarter and a half, we've done that 4 or 5 different times, and again, reacting to the volatility of the market. Again, as markets appreciated, again, we took equity off the table. As they depreciated, we added to equity, which is maintaining a discipline in volatile markets, and that has been what we have done with these portfolios. So, and again, as I pointed out, when you look at those benchmarks, this policy has really only been in effect through the end of 2018, but I keep that benchmark there more for reference. So with that, do we have any questions?
As you look at our portfolio versus others that you have under management, where was there any area that might have been a miss for us as far as the allocation that we've given to you, or do you have any recommendations for things that we could be doing different as far as allocation?
Your allocation is pretty much in line with where we see allocations for these types of accounts and for these share or foundation type of accounts. So you're in line, and your ranges allow us the ability to, particularly in this environment, to actively manage that allocation. So we can take it off the table. And that's the important thing. So we can underweight a category when we don't feel it's attractive, which is some policies ranges are very tight. So when we say we don't want allocation, we want a lower allocation to international, it doesn't allow us to do this. Your policy does allow that. So it gives us broad ranges. So I would say that as far as the investment policy itself, there is no restriction as to how we manage money. The only thing that really was the issue, and there's nothing that the policy could have done, was as I showed you fixed income, but that is something across the industry. If you look at anybody who was holding fixed income funds in March, when credit, and when I say credit, that means anything outside of government bonds, just seized up. You had a difficulty selling any type of even high quality corporate bonds at the end of March. So those markets versus the index, and the reality of the market was different than what the index actually showed. So performance of those portfolios or of that category during that time frame suffered. Now you would see that across all of our portfolios and across the industry, that fixed income. But you've seen how that's bounced back over the last 3 or 4 months. So we've seen that market recover. And that, the headline is always what's happening in the equity market, but equally important is what's happening in the fixed income market. And also the focus, fixed income, at some point we will see that market stabilize, and we're not going to see interest rates. We'll see them stabilize, but they will have to go up from here. So that's going to moderate fixed income returns from this point forward.
I have a question regarding, you mentioned that our ranges in our investment policy give you some flexibility. And I think this might have been a point of conversation previously around fees. But humor me for a moment, if you would.
Okay.
I looked at the Hauk fund, not the Sudi Acres, but the other Hauk fund. And the difference between net and gross of fees is 0.4%. So if I apply that to 1.6 million, I get plus or minus $6,500. And that's not chicken scratch, and fees can certainly suppress returns. But are there instruments you're steering away from because of fees that would be available to you if you weren't restricted? I guess what I'm saying is if we could improve our returns, and I'm not suggesting we could, but if we could improve our returns by an additional point, that would, by paying some fees, that would far and away eradicate, if our fees doubled, but we increased by a point, we'd be okay. We'd still be net ahead. Do you feel restricted by an attention to fees? And that may have been part of our direction. If so, I apologize for not remembering that, but I was just curious if that took some ranges of options off the table.
Yeah, very good question. There are two types of fees. One, those are the explicit fees, the account fees, the fees within the funds, and we don't make any money from the funds. And that's where we try to pay. We try not to sacrifice return, but fees come right off return. So if we don't see opportunity, and active funds tend to have higher fees than passive funds. So when you see the index or where you see, let's say, iShares, those fees are much cheaper with those funds. So if we don't see the opportunity to outperform that passive, we're not going to have an active fund. And in large cap, that's particularly the case. So, and Helen will go over that, but the fees that I control are what we invest in, and we don't have any restrictions as to what we can invest in. So what we will invest in an active fund that has higher fees if we see that opportunity. But if
Great.
that opportunity is not there, we're going to try to keep those internal fees down. And again, where we do use active, they're all institutional shares, so there's no transaction fees going in and out. So I try to control and minimize those fees. The account fees are different, the external fees, and Helen will go over that, but that doesn't restrict what we can invest in.
Terrific. Okay, thank you.
Well, that actually sounds a lot like a segue for me to
Yeah.
talk about our fees if there are no other questions for Keith.
Yeah, well, we didn't practice that either.
No, it's true. That just worked out. I mean, we to hone that up for our next couple meetings. So if everybody has access to a document that was sent out called Cincinnati Parks All-In Fee Analysis, and it's dated as of June 30, 2020. I like to present this document to address the very issues that we were just speaking of. So what are the internal fees that are paid at the fund level, coupled with what are the sort of out-of-pocket fees paid by the trust to Fifth Third Bank for Keith's portfolio management and the costs of administering the trust, well, the multiple trusts in this case. So if you have this document and you take a look in the first column, it lists every asset held in all of the different portfolios for the trust, because we are aggregating the market value for all of the trusts to calculate what the fees are. The out-of-pocket fees.
I'm sorry. Can you remind me the sender name so I can search it? I'm not finding it. I want to make sure I pull it up.
That would have been, that came from Helen Webb, and I think she sent that, I'm not sure what day you said it. It was before the last report.
Perfect. Thank you.
Yeah. The next column on this sheet shows the allocation, so the percent of the portfolio that's devoted to each individual asset. And this is just a repeat of the information that's in Keith's report. The next column translates that into the market value of each holding in the portfolio. And then the internal expenses column shows what the what we call the fund level expenses are. So these are the fees paid to the fund at the fund level before the value of the fund is determined. So they're not out of pocket. They are already taken care of at the fee. And then the last column translates that internal expense ratio to a dollar amount annualized. So you see, for instance, if you look at the Harbor Capital Appreciation, if you held this position of $167,515 in that fund for a year, you would essentially pay Harbor Capital just over $1,100 for their administrative expenses. And then if you scroll and look at the bottom of this report, we have the Fifth Third consulting fee, which is currently averaged out to about 59 basis points per year, or 0.59%. In dollar terms, Fifth Third is paid from the trust $40,312 annually. That is based on the market value. When we add that to the total internal expenses paid at the fund level, we get $22,512, or 33 basis points. So all in, the cost of this portfolio is 92 basis points. A note about fees and the funds, Keith had referenced this earlier. We invest in institutional class shares, which will have the lowest fees available. Additionally, as part of our commitment to transparency and to free our portfolio managers up from any obligations to invest in certain funds, were we to receive any what's called a 12B1 fee back from any of these funds, this would be offset against the trust's fees. We don't keep that money. This allows us to be completely independent to make the best decisions for your portfolio. Does anybody have any questions about this?
It's a super clear presentation of the information from my point of view.
Thank you. I think it's important, and Fifth Third thinks it's important for you to understand the full cost of your portfolio.
And we do that, and to follow up on your previous question, that allows me I can invest without regard to what the fees are. So that really follows up on that question. It allows me the flexibility to do what we need to do.
Great.
Well, thank you, Helen and Keith. Is there any other questions for Helen and Keith?
Craig, I'll just ask you with them on the line, access to information, is it easy for you to pull data?
Yes, yes. For really all the accounts, Fifth Third as well as other ones, everything's online. So usually most of the reports that from a market standpoint, monthly statements are available within 5 business days after the close of the month. So no issues at all. Fifth Third, anytime I have a question or inquiry, they respond immediately.
Thank you for that feedback, Craig. And we really appreciate the opportunity to meet with the investment committee. I know it has been a long time, and there have been a lot of changes between this meeting and the last time Fifth Third had an opportunity. So we are very happy to be there today.
Well, and Helen, this is Jim, and I want to say to you that the reason why it might have been a little bit longer that we've talked with you is that, quite honestly, we have not been concerned or haven't had specific issues that we have wanted to get in front of you before this time. So thank you for what you're doing. And during this crazy market period, I appreciate the way that you guys have managed the funds. Obviously, we don't like experiencing markets like this, but you got the rest of the year to make up for it. So,
Right.
Well, if anybody can, it'd be Keith. He's
Yeah.
mentally
Yeah, right.
you know,
Still got that vision to-
and even if you're not in front of us, obviously, I know you're in touch with Craig as much as you need to be, but if along the way here, if there's other things that happen in this market, if there's things that you think we need to be aware of or take action on, we're flexible and can do that. But in the meantime here, the way that the portfolio has been balanced and managed, we're very appreciative of your work.
Great. Thank you.
Hey, Keith, now I do have a question in regards to kind of looking forward. I know, wish we all had a crystal ball, but looking at kind of a lot of the impact of really the federal, back in March and April, the government really stepped in to help out organizations and entities, but seeing that potentially decreasing or even going away, what do you foresee happening potentially in the industry, and how is Fifth Third kind of going to look at that forward looking as far as the market?
Yeah, and I think part of it is you have to look at the market as a whole, because already there are different aspects of the market that have been impacted. But when you look at the global part, the market has done okay because particularly large cap, big companies have done pretty well. Now, obviously, the next potential shoe to drop, and I think this is what you're referencing, is state, local governments, or even schools, because at some point they're going to need help. Now, our expectation is that at some point the federal government will step in and provide that help, but that is the next impact on the market, and that could impact things such as it can impact the employment rate, because that'll be at some point, because state and local governments have to balance their budgets. The only way they can do that, the biggest expense for any organization are their employees. So we're looking at that and we're aware of that, but it's when you look at the market as a whole, it will determine where we invest, not so much that we will invest. So you really have to look at what parts of the market. And if you look at, even when you look at the investments in the portfolio, that's why we have those factor investments that allow us to go to areas to shift the portfolio, for example, to things that have lower volatility. Because no matter what happens in the market, staples will do well because people are going to eat, people are going to buy toilet paper and paper towels if you've been to the store in the last 6 months. So it just it's the impact is more where you invest as opposed to how.
Yep. And I still don't
Perfect.
understand paper towels. Why are they
Yeah.
still sold out?
You're telling me paper towels or toilet paper. I think you use the same amount regardless, but.
Yeah. Well, I want to thank you guys for your presentation and taking the time with us today. And as I said, we appreciate the partnership we have with Fifth Third and look forward to continue to do business with you.
All right. Thank you very much.
Thank
you all
you.
very much.
Thank you, Helen
All right.
and Keith.
Bye.
Bye-bye.
Bye now. Well, I for one, it could have been a whole lot worse, and hopefully the next time we look at numbers, it'll even be better. But, I think what they're doing, I think is pretty conservative, and I think it protects us on the downside, as we can see here. Well, let's move on in our business here. We had next order of business was approval of the minutes from the 24th of June. I assume everybody's had a chance to take a look at it. Any changes, corrections? Hearing none. Could somebody give me a motion to approve?
Approval.
John, second?
Second.
All those in favor, aye.
Aye.
Those opposed? Perfect. We've got those approved. Craig, I'm going to turn it over to you now to talk about the Fleischman Fund. I'm a little confused on this one, so I'll let you take it.
Yeah, this one here, I'm going to go ahead and see if I can pull that document up and share my screen. I don't know if, Mary, do you have to give me, no, I think I can. Oh, I can. Here, give me 1 second.
Minimum distribution.
Can you repeat that, Kevin?
Are we talking about the required minimum distribution? Is that?
Yes, and that's the one we're talking about, and that's once I identify where I put that, then I'm going to share my screen.
It was your August 24th email to us.
Yeah. So I'm going to put that up right now. This way you all have it. Let me know when you can see the screen.
Not yet.
You need more
I just froze up there.
There you go.
Gotcha.
There. Okay. So early this week, I received a communication from US Bank, which they received information from PwC in regards to the Fleischman Fund. It's the account 1272. It's the one that's the leaser dollar amount. It has around $766,000 in it. And it was informing us that we did not take the distribution amount that's we're supposed to take from this fund, and that's supposed to be 5% of total fair market value. And in regards, if we do not take that 5%, then we could be held from a taxation penalty standpoint of 30% of that remaining amount.
Craig, I'm a little confused. Maybe I'm sorry to jump in, but why is this considered a private foundation as opposed to just an equity investment or a trust investment?
I would have to reach out and identify, because when I look at the trust documents that we have, they do not indicate the minimal, like a range that we must accept and the information I'm sharing is from that came from PwC.
And I assume PwC must be US Bank's auditors or something?
Yes.
Okay. Well, my whole question revolves around this distinction that it is a private foundation. And that's where I think you got to get the answers to that.
Jim, is the fund that's going to the park board only a portion under the trust? So is it sort of a sub trust, or is this the entire trust? And are we trustees of the entire trust?
I think it's the entire trust. Somewhere along the way here, because we have two Fleischman funds, and somewhere along the way, excess money was pulled out, and this is where I'm getting a little fuzzy on the history, but I think that and Craig, correct me, but the main Fleischman fund, isn't that restricted to just Fleischman Gardens?
The Fleischman Fund, when I look at the documentation, is the funds must be used for Fleischman Gardens first, but then can be used elsewhere.
Okay, well, somewhere along the way, this fund was split. And that's where this smaller amount got set up separately. And that's where I think we'd have to go back and look at the documentation or try and find out when that was done. If it might have been set up wrong, so to speak, or set up in a way that triggered it being a foundation versus an endowment fund.
Thinking about it, these funds, I remember a lot of conversation when park board and foundation and city were in a conversation around sort of the MOU. And these endowment funds are under the city of Cincinnati's EIN, aren't they? Or is there a separate EIN?
They are I think they are, well, that's a good question. I'm trying to remember. I think they are under the city's EIN.
Then I would think it would default to the form of organization not being a 501c3 or whatever. I think it would be a municipal government, which I wouldn't think would have it feels to me like maybe US Bank checked a box at some point, some number of years ago, and that's triggering some PwC artificial intelligence review to say, oh, wait, this is a charity and they didn't, this math doesn't work. Therefore it's, but if we're under the EIN of the city, I think the city may not have complete and total operating latitude due to terms of the trust agreement, but it's still the organization is the city, not some other group that has a distribution requirement.
Yeah, I'm thinking that and along that same line, John, since this is the only time this has come up, I think it's just classified wrong.
Yeah.
And I mean, I would agree with you guys. I think if this were a real issue, it would be a real issue with all of the different funds that we have.
Right.
Yeah, that's what's interesting to me, to where this is only communicated for this fund at US Bank, where yes, we have the other Fleischman from fund theirs, and I know we brought over like the guy in Drabner, I believe, maybe, which one did we bring over Drabner? But the other Fleischman fund's been there, and nothing was mentioned in regards to the other Fleischman fund.
So that does feel like a sampling audit thing that pulled this.
Yeah.
Can we refer this to the solicitor's office for a?
Well, I would first just have Craig follow up with US Bank and get an understanding of why this letter was received. I'm a little concerned that it was dated 4/30/2019.
Yeah, and this is the letter received that was sent to me on Monday or Tuesday. So
Well, if you would, whoever sent it to you, I don't know if it was our contacts at US Bank or what, but I would go back, first try going back to them and get an understanding of where this came from and why this was classified as a private foundation. And then if it gets hairy, then we can go to the solicitor's office. But I'll look in my files here too to see if I've got the original document or a copy of the original documentation. And maybe you could do the same, Craig, for this little fund.
yeah, I looked everywhere for this, for the Fleshman, and I have documentation regards the Fleshman fund, but it doesn't really go to this granular level of just this particular fund.
Okay.
It goes to more the usage of the income from the fund.
Well, perhaps then you can go back to US Bank and ask them to provide you with a copy of the document that they have on file so that we can see what, again, I'll look in see if I can find something here too, but I would try going back and just getting more information from US Bank. And then if it looks like it is indeed an error in the way it was structured way back when, then we can get the solicitor involved.
That sounds good.
And it may be that the solicitor will have to use outside counsel because I'm not sure that they've got charitable tax experts on staff at the solicitor's office. But I think
Craig,
we'd let them make that call.
and Craig, if you'll recall, US Bank is the bank that had gone and early last year had Taft Stettinius involved to do a review of all of their endowments because we had to sign some document to keep it current for taxable purposes. So yeah, I would go back to US Bank and they might be able to provide you with the document.
Okay. I'll follow up with US Bank and see if I can obtain information from them, and also see if there's anything else I can locate within Parks folders in regards to this, and follow up after that.
Yeah, and I'll look, Mary Jane gave me a file that I think came off of your computer system. So I'll take a look in that too to see if there was all related to endowments. I'll see if I can find something in there as well.
Okay, thank you.
I'm thinking that's where I remember seeing something about Fleischman being split out at one point. I'll take a look.
And Craig, just to keep me straight on this, for the endowments that are specifically related to a particular item in the parks. So for example, I believe the Meyer is Hyde Park Square. Is that correct?
The Meyer fund is a unrestricted fund.
Okay.
The Bettman fund is a restricted fund. Like some of them are set up from a restriction standpoint. I'd have to look at Meyer to see if it states anything about Hyde Park Square, but something like the Bettman fund is very restrictive. But then you go to the Geyer fund, which is restricted to the Espionage, but then becomes unrestricted as long as that's maintained. And that's the same with the Fleshman fund. As long as the gardens are maintained, the remaining dollars can be used elsewhere.
And I get that. I mean, I guess my point is making sure that we're collecting every dollar out of these endowments that we can reasonably attribute to the particular accoutrement that belongs to parks that relates to the levy clock. So if we're using 3 laborers, 6 hours, we're peeling that. We're not taking that out of the general fund. We're peeling that out of the levy clock fund.
Yeah, and that's the intent, to where whenever staffing is permitted with the trust, that we can reimburse staffing dollars, that once the general fund dollars are used up, then that reimbursement then will start coming from restricted funds and even unrestricted funds. And that could include city funds as well.
Well, but see, I would say it would be the opposite, that
I agree.
if it's not using up the general funds, it's use up the restricted funds. And then if there's not enough in the restricted funds, then we go to general funds, because there's so many of the 5,000 acres that don't have any restricted funds dedicated to them. That's where we should be using our general fund money. And the restricted funds should be the first dollars out on those things that were so city acres. First thing we should be doing is going to Fifth Third saying we need a distribution to redo the house at City Acres, if that's what we're doing.
City acres, yeah. So for the city acres, there is a set amount that we receive from Fifth Third every year. We don't control that amount. That's something that the trustee controls, and we're the beneficiary. In regards to, like, when I'm referring to staffing dollars, staff gets paid out of the general fund. They don't get paid from separate necessarily, unless it's a larger fund like 332 or 329 or 318. They won't get paid out of like the fund 430. We have to reimburse it to that general fund at the end of the year, if that makes sense. But as far as non-salary expenditures, definitely the staff is given guidance to go ahead and utilize those restricted dollars within those funds before they start using dollars that can be used everywhere.
Well, I guess even for staffing dollars, assuming that there's no specific prohibition on the in the trust, that and I know that what you're saying may be, as a practical matter, the city's paying out of the general fund, and then we're reimbursing the general fund out of the restricted funds. As long as we're keeping track of the hours that staff is using on the levy clock or on the Geyer Esplanade or whatever it might be, we should be capturing every dollar of that, because these endowments keep going up in value, this year being an exception because of the market. But the endowment dollars keep going up, the general fund stays flat or goes down. We need to be attacking these dollars first for the purposes for which they're permitted, and then go to the general, and then we can use the general funds where there isn't another use, in Burnett Woods or, Mount Echo Park or wherever it might be. We don't have a donor attached to those dollars, so we can't use these other than excess funds. It just seems we need to make sure that we've got a way of capturing those dollars. From a lawyer's standpoint, it was, in the old days, the timesheet that I kept when I worked on a particular client matter. It was 10236 matter 12, and I spent 18 minutes working on that matter. I captured that at the end of the day, and that way then the client got billed for that. It would be the same thing with this, only it would be an internal billing. Your grass cutter isn't spending the whole day cutting the Hyde Park Square, the Geyer Esplanade, but he or she is spending a half hour cutting and trimming another hour, and an hour of travel time. So total for 2.5 hours a week, that person's salary should be allocated to the guy or Esquina.
Yeah, and I think Craig,
Or that way.
yeah, I think, and Craig's been doing a lot more analysis on that. I think that's why this year he started making sure which of the funds are really restricted versus non-restricted. And I think the way I think about it, I think what you're saying, Kevin, is that we should be sure we are not spending any general fund dollars when there is restricted fund dollars available to cover that expense. Which is
Yeah.
just saying the same thing, yeah.
And at the end of and if it has to be that it's a general fund dollar gets spent, but then it gets reimbursed from the fund.
Yeah.
That's Craig, that's your deal with the city to do that. I just want, yeah. You said it much simpler, Jim, than I said it, but that was the.
But
Yeah, and I think this year we're definitely on the right path for that. Unfortunately, I wish we had the technology that could track every hour, every minute somebody's at a certain location. But I know Patricia Thompson, my senior accountant, she works very closely with operations to identify where those individuals will work and how much time is spent there. And I do know urban forestry, in which we did reimburse their hours this year. They do a very good job. Crystal and Matt do a very good job of identifying the hours that they spend helping operations out, but also need to take a step further to understand from a Larry standpoint, Larry Parker, how many hours does he support urban forestry as well? So that team is doing a really good job, but it is looking, okay, outside of that box and saying, how can we do this from an hourly standpoint elsewhere? When can we get to technology? And really with the pandemic, it really pushed Matt DeBone back on the technology. What he's been looking at, working with Crystal and them on in other areas, is trying to get to that point, but it's been pushed back. But we do need to get there, and we'll be there eventually.
Well, and the technology's out there. I mean, there's very inexpensive technology now that's out there, because pretty much every industry does this, even if you're doing internal billing like this. Literally, it's an app on your phone and you plug it in and it'll keep accurate track of the miles traveled. And it's like a stopwatch. You hit the button when you start working on this and you hit the button when it stops working on it, and it does all the calculations automatically and prints out a nice report for you.
You're preaching to the choir. I'd love to have that about a year ago or two, right before I started. It'd be great. And we are working on that. That definitely is something that needs to be done. It's just really buying it and getting it implemented. And I know Matt's working on a software program that will do wonders for the parks. It's just, how can we get this expedited in this kind of environment right now, so we're able to start tracking what we need to track? Because even from a vehicle standpoint, we don't have GPS on our vehicles. So that's something that this day and age, who'd fathom that you're not even tracking your heavy equipment and vehicles with GPS?
I mean, that's crazy. You could buy a $40 a month phone and not allow it to be used as a phone, but just simply have it in the vehicle, and it would keep track of your GPS.
Yep. And I think that's really just biting a bullet as far as iPads, and especially iPhones or smartphones, is like for the associates, that do we go that direction with 180 associates where they do have their own phones that we're able to track, then they're responsible for tracking what they're doing.
Okay, well, I'm going to pull us back to the agenda. I think I don't think anybody disagrees that's where we want to head. And I know Craig's been anxious to have some of that software as well. So we'll keep an eye on that. Craig, do you want to walk us through whatever you want to highlight with the financial reports that you had sent to us? You sent us a couple.
Yes, I sent the performance report as well as the Parks Endowment summary. We can go through the performance report first.
Okay.
So when you look at the performance report and versus, I should have sent you the last one, but you could tell that we did from the end of March to now that, as you know, the market has come back. It's not back to the pre-pandemic mark yet, but it has come back pretty strong. So if you had time to go through this report, if you identify any outliers, I know P&C's been a real hot topic lately in regards to their performance.
Craig, first of all, on this one with the performance, what's the date of this?
This one is the end of June. So the
okay.
performance reports are performed quarterly.
Okay, so this is 6/30. Okay. Obviously, the big outlier, it looks like on a calendar year to date is Ball and Gainer. And that's probably due to just the market segment that they play in with the high dividend funds. I'm not sure why, but they look like, when you look on a calendar year to date, which is what I like to focus on versus a month or 3 months, they took the biggest hit with a 6.7 loss for the half year.
And I did reach out to them in regards to the 1 year performance because of the benchmark versus what their actual came in to validate that their equation is correct. And they did validate that 2.06 is correct versus the benchmark of 7.81. And they really didn't provide any guidance or any information on why there's such a variance, but they did indicate that was correct. But you are correct with their really portfolio is different than the other ones. They do have a little bit more volatility, a lot more volatility than the other investment managers.
Craig, if you get a few minutes, maybe you can just give them a call and just say that at our investment committee meeting, a question was raised. Could they just give you a brief explanation for their year-to-date and 1 year data? It's the year-to-date, obviously, because they were well ahead last year at this time, I believe. So if you could just ask them for just some commentary on why the nature of their fund would lag so far.
Yeah, I'll reach out to James and see what he has, see if he can provide some information.
I'd also be open to, since this is June 30th and we're at August 26th today, if there has been, I don't know if there would or not have been, but if almost 2 months later, there is a appreciable, it's not as remarkably of an outlier, I'd be curious knowing that as well. If recovery happened in different segments at different times, whatever, because we do have a generally positive history of outperformance, I'm willing to accept some quarters of underperformance, not forever and ever, but and the timing variance is something I think worth contemplating anyway in that.
I think you're going to see a little bit of that. They certainly bounced back in July. I don't know how they're doing here in August, but they may still be underperforming. But to your point, John, they had a pretty good July, and this hasn't been a terrible month for dividend stock. So they might get back in line.
Yeah, I fully agree, John, too. It's not a quarter for quarter, what have you done for me lately? I just, if there was just a general information that they say that, yeah, in times like these, blah, 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 or we'll see a bounce back next month.
Well, you know what's kind of interesting, Jim, is I believe Jim Russell said, when the market is way up, we may not go quite as far. and when the market is down, we might not dip as low. And now this is a little bit contrary to that, but yeah, you can't measure it in small slices. I'll be surprised if they don't tend to outperform the benchmarks and everybody else by the time we're done with this.
I agree with you, Steve, and that's where, again, this is such a crazy market. It could be a couple of their holdings or something that to this point screwed them up or something. But yeah, no, I'm not. I'm definitely not absolutely concerned about it. But since it's the only real outlier, just if we could just note that we'll follow up with them for a little commentary, that'd be great. Does anybody else have any other, it's, I think we all see it in our own portfolios, but when you look at Craig's summary for July 20 and we're before the commissioners fund, the endowment total at 18,668 compared to 19,071, it does show that, markets really have recovered. I don't know. I don't get it, but I'm not going to, not going to send it back.
I had an observation and a question. I think that Miles Edwards fund has really dragged down the portfolio through June because, for example, I've got about $17 million here, and we were underwater, but only by about 2.3 or 2.4 gross of fees versus our 3.8 that we're looking at here on this chart. And then I'm a little curious about Craig, primarily how you feel about those Fifth Third fees that we just looked at. An all-in cost of 0.92%. That's no particular bargain. Admittedly, my portfolio here is more passively managed, but Jim, you'll recall I'm only paying US Bank 20 basis points. And I know that I'd be curious as how this compares, Craig, to what the others are charging you. But normally these local banks charge a very discounted management fee to not-for-profits. And it was kind of interesting. Normally, the fee to the money manager is higher than the fee to the trustee. In Fifth Third's case, that was the opposite. The behind the curtain fee was only 33 basis points, and the fee paid to the bank was 59 basis points. And maybe it's different by our various funds, and maybe that wouldn't be the case with PNC and US Bank, but historically here at the Y, the behind the curtain fee was higher than the trustees, the bank fee. And, 59 basis points is kind of expensive. Now, you don't mind paying an extra 30 basis points if you're getting it back in return. But the last thing I'll say is I've got this very passively managed portfolio that's outperforming this one, and I'm paying less for it. That's all.
That's a good point. Maybe what, Craig, do you get fee reports from the other banks like we just got from Fifth Third?
Yeah, so with the performance reports that come out, that does indicate the fees. I don't know if all of them, I believe all of them show the fees amounts, but I'll have to take a look at a couple of the reports to see how all-in fees compare to Fifth Third. And I'm not going to speak too much to that because I want to see the numbers first.
Yeah,
before I make
maybe
assumptions.
maybe that's something you could take a look at for us for the next meeting, just to compare what they've done. So it's nothing urgent today based on whatever you're working on, but that might be something good to look at and send to us for our next meeting.
And I didn't feel like it was, I was wondering the same, I mean, 59 points to buy iShares.
Yeah.
Okay, I'm thinking Schwab can cheap that up a bit. And I know that's not the extent of it, but um, I don't think they're 100% high. I'm not even sure they're 50% high, but they might be 10 or 20% high. And part of our responsibility is to work to ensure that they aren't. It's not urgent. I don't think we're being badly served or not being good stewards of the funds, but we could maybe do a shade better there.
Yeah. Well, and this is the right time after they've had this annual presentation to us to go back if we've got a question like that, just to see if they can sharpen their pencil a little bit.
Kevin, you were muted. You said something and you're muted.
I was just saying, since we're the beneficiary only on these Fifth Third accounts, I'm not sure how much room we've got to say other than to really go back to the original document that purports to make us a beneficiary. Because Jim, if you'll recall,
Yeah.
I had a contrary opinion on that.
Yep. No, and that's an excellent point, Kevin. The only one of the Fifth Third, it's crazy, but that little levy clock fund of 20-some thousand dollars, that one we clearly are the trustee as well as a beneficiary. But the other ones, all the Helen Meyer, those Fifth Third is the trustee. So whether they are, because of that structure, able to charge us more, or they're extracting an additional fee that the other ones aren't, that could be.
Review it against the other investment managers to see kind of where they're at. Because I think even though we're not the trustee, we can always look at that as an opportunity to see if we can reduce the fee amount.
Sure.
Well, and my point was, we could also push back and say, hey, guys, we don't think you're really supposed to be the trustee because it was this one line in this testamentary trust that says the park board should get this money. It doesn't say that Fifth Third should continue to be a trustee forever and ever for the next 1,000 years.
Yeah, Kevin, I haven't lost sight of that one as well, and that's where perhaps one of our legacies that we could leave to the park board is cleaning this up while we're sitting here. So, yeah, I think that's a good point.
But if they're in line with the other ones, as we said earlier about spreading it around to the local banks and trying to keep as many people happy, as long as we're not getting jerked around.
Yeah. Okay, well, Craig, maybe you can, anybody else got any questions on these, on either the performance or just the summary? Okay. Craig, let's move to the next. You wanted to discuss the Schmidlap Lawn Trust.
Yes, I'm going to pull up the document. Give me 1 second. For some reason, it does not want to pull up. So this was one that we had questions in regard to. Could this trust be transferred over to us to manage it, the trust? And I'm sorry, my computer is frozen right now. I had the ordinance and everything ready to go. The answer is, so this was this was a pretty old trust. It was dated from 1892, and the trustee was the sinking fund, the board of trustees of the sinking fund. And then I'm trying to look at the ordinance, but in the 50s, and Kevin and Jim, you may know more about this. I don't know if it's in the 50s or 60s, the sinking fund then transferred all responsibilities over to the city treasurer. So the city treasurer is the trustee of the Schmidlap Trust, and we are the beneficiary. So for us to be able to move this over, the city would then, treasury would have to agree to move it over to us, which that for them, they look, and it really for them didn't make much sense for them to go through that exercise.
It doesn't, you're saying it doesn't make sense for them to transfer it?
Yeah, since they are the trustee, they indicated for this trust that it doesn't make much sense for them. They want to continue managing this trust. Also, there is a report, and Nicole hasn't provided it to me yet, that does break out each of the trusts that the city manages. So I'm going to be following up with her to obtain that report. And once we obtain it, it's an annual report that's distributed. And once I receive that report, then I'll share it with everybody. But as far as the question of are we the trustees of this, the answer is no. It was the sinking board of trustee or board of
Yeah.
the sinking fund. Then all of it transferred to the city treasurer.
You know, I think the issue, if I'm remembering why this even came up, was that it looked like we were not earning anything on it over the 100-some years that they've held it. And there's only, I think, 3 or 4. I mean, it's the AMPT, the AMP fund, the Grospec fund, maybe the Schmidlap fund. There's only a few that are like this that go back. And I think the whole issue was, why aren't we earning more money on these? Or why aren't we earning any money on these? I think that's what generated this whole discussion, wasn't it?
Yes, that was because looking into it with the Schmidlap, it was a decent donation in 1892 that if invested kind of with the endowments that we manage, we should be getting a substantial amount, and it should have a pretty decent value as well. But you are correct, we're not really seeing that come across. We're seeing smaller distributions from this trust. And that's where the question really came up. Well, if you're provided this substantial donation in 1892, why hasn't this trust grown?
Yeah.
And but it hasn't shrunk either?
One second.
'Cause it seems like if it hasn't shrunk and we've received some distributions, there has to be some degree of return. What I'm wondering, and this is purely conjecture, so for the minutes, note that this is not an allegation of any measure, but does the city get one set of returns and then deliver to sub-trustees a lower set of returns? I don't know if they have the capacity or means of doing that, but it's kind of weird. If it's not in fact a declining balance, then there has to be some return, but if it looks like zero, I can't.
Yeah, and that's where I'm waiting for the report that Nicole Lee indicated that's distributed annually that does break out the value of these to see what is that value of not only the Schmidlap, is what is the value of the Grospec, what is the value of the AMP fund. And I went ahead and shared this the screen for the transfer of powers between the board of trustees of the sinking fund to the treasurer.
And this is state code. This is the Ohio Revised Code. So
this was 10-1-53. Kevin, did you vote for that or against that?
as I said, this is the Ohio Revised Code. Literally, we just took out reference to the sinking fund out of the charter in 2015. That was one of the clean issues that we did.
Right. Craig, I think for this issue, I think if we could raise the issue again, I mean, we see what the balance is. I mean, in the city's monthly financial report, you can go in and see what the fund balance is on Grospec, Schmidlap, Amped Fund, all of those where they're little funds that the park board gets pennies for every year, it seems like. perhaps you can go back and see what the balance of those funds are, like at 6:30 or whatever, and just raise the issue with them. Can you get from finance or budget departments what has been that balance over the past 5-10 years? And that should show us if it's growing or diminishing or whatever it is. But I think the whole issue was, at the time, it looked like these funds, something wasn't quite right and that they hadn't appreciated like they should have.
Yeah, and that's my drive, is to get a little bit more clarity of what's occurring with these funds and what do they really look outside of what's in CFS. So I know I can go in CFS and see what they look like, but is there something else that's missing that's not really telling the whole story?
Yeah.
And Jim, this is probably another thing that we should get copies of the actual documentation that created these trusts, just like we did with our endowment trusts.
Okay.
Again, as part of our legacy.
Yep.
Okay.
Okay. Discussion on outstanding items and park projects, just to bring you guys up to date. Obviously, you saw in the press that the city and county reached agreement on how the path forward on documents for Lot 23 on the banks. So as of today, work is continuing down there. They're looking at, I believe, spring of next year. They're hoping that Lot 23 is ready to go. We haven't actually started work above the platform, so to speak. Most of the work in the underground parking structure is just about done. And they are doing waterproofing right now of the platform, the podium, and it will be soon that actual construction on the park begins. So that's obviously a big project that we've got on the boards. We continue to talk about the boat dock. We're looking at trying to see the degree of public interest in helping us raise funds to meet a shortfall that we have in funding for the boat dock. So that's the next step that we have here, because as we sit here, we've got a substantial shortfall between the cash committed and what it will cost based on latest documents for the boat dock.
Jim, I may have an update on that next week, and we can talk about that at the next meeting. There's a proposal to just move away from the
Manager at risk, or
no, the grant that we're getting from the state and federal government with all of its requirements, and somebody else coming in, moving their existing dock headboat in and serve as operator with the existing dollars being put in to get a good gangway and get extra docking for the pleasure boats along there. We might be able to do it for what we already have sitting in there, the 1.3 or whatever that we've got left.
Yep.
And that person, and then we're not having to worry about getting an operator contract, because it'll all be wrapped into one. And this guy's obviously got a lot at risk because he's got his own investment in there. So I'll talk to you offline on that.
That's
one.
great. This is an example where the community and we're trying, Kevin is spearheading this. We're trying to find a way to provide a service and provide an amenity that was promised to the boating community back when an old dock was taken away. But the realities of costs and cost to erect, as well as cost to operate, we're trying to find a way to bridge it so that it's not an annual burden on parks. So good to hear that, Kevin. Other parks, nothing is moving on Lido Park. We still have pending litigation there, so we're waiting for that. Burnett Woods, we've approved a contract where it's a multi-year contract for someone to come in and do invasive removal throughout Burnett Woods. And we're hoping that the process that this third party goes through will be a model for us to sort of implement at some of our other parks. Parks are just being overrun, as I'm sure you all know, with invasive species, and it's killing the natural vegetation in our parks. So we're hoping that this project, part of what we like is that they help train volunteers and they train park staff in what they're doing, so that it will be something then perhaps that we can roll out to other parks as well. But honeysuckle has just taken over everywhere, as you know, and this is a big project that we're undertaking. Mount Airy, we're still moving forward. Cora, the Cincinnati Off-Road Bike Alliance, continues to build more biking trails in Mount Airy. So it's still moving along. We've got out in California, Cincinnati, California, we've got a new facility going up at Stanberry Park. That was money that was provided through a state grant for us. And that's in process of being constructed. Was about $160,000 project that we received state. I think that's the amount of it, somewhere around that area for a project out at Stanberry Park. Kevin, am I missing, or Craig, am I missing any projects?
Just that there's some normal capital replacement going on in various parks across the city. So playground equipment is being replaced. And so we are using some of the capital dollars that's allocated to the parks by the city every year for that.
Yeah.
And next month, we should be getting at least the preliminary report on our park needs assessment.
Yeah, that's something that we're really hotly waiting for, is I think I mentioned to you all earlier that we engaged a third-party consultant to assess all of our parks and all of our facilities, and giving us a comprehensive report as far as the needs of each of parks from a maintenance standpoint, as well as a replacement standpoint. So we're really looking forward to getting that, because we're hoping that becomes our roadmap for capital spending going forward on where it's needed the most. So do you guys have any questions? John, Steve, we don't see you that often. I want to make sure you feel like you're up to speed on what's going on in parks.
I think I'm up to speed. I still read the newspaper, Jim.
Well, just remember that there are two park boards. One is the city of Cincinnati, and one is Great Parks of Hamilton County.
Oh, yeah.
And we prefer not being in the newspaper, except for grand openings of spectacular parks here in the city of Cincinnati. So
You do seem to be sharing the stage the last 2 weeks. So.
Okay. Craig, do we have a next meeting or do we need to set that?
We need to set one up.
Okay. What would you be looking at?
I think our bi-monthly meetings are working out pretty well. Is there any opinion with you all?
So look at something in October?
October, and also identify who would be, I think it worked out pretty well today with the presentation.
Yeah.
I think it'd be wise for us to get.
Letting go first is nice too, because then we can.
Yeah.
Exactly.
Who do we want to hear from next? We heard from PNC last time.
We have Ball and Gainer. So I think US Bank, they would be up again.
I think they would be.
I think that's right.
Yeah, I think you're right. So we would be looking at perhaps September. No, we're looking at October. So maybe like 20, 21, 22. Do any of those present a problem or I would prefer not the 20th. I've got a CRC board. Either Wednesday, the 21st or Thursday, the 22nd. Does anybody have a strong preference?
Good either way.
I'm sure on the 22nd whether or not I will have a meeting with my Columbus Independent Living Group.
It's Wednesday.
Supposed to be the Thursday before that, but people were miscounting the Thursdays, and so everybody.
Should we look at Wednesday, the 21st then, Kevin?
That works for me, yeah, because I can always bag out of the committee meeting. It's hard to bag out of the meeting that I'm running, though.
Yeah. Steve, what do you look like?
Wide open, both of those afternoons. So the 21st.
Yeah, Craig, if that looks good, why don't we plan Wednesday, the 21st?
That sounds great. Then I'll reach out to US Bank. That should give them plenty of time to put that on their books as well.
Super. Great. Well, we're right at an hour and a half. Anybody else question, input for the common good?
No objections to adjourn.
Perfect. Well, then I'm going to take that as a unanimous. And Craig, if you could sign us off from online, that'd be great. So thank you guys. Appreciate it.
Bye, buddy.
Thank you.
Thank you. Bye now.